For the past 3.5 months, the S&P 500 has been stuck in a sideways consolidation with 7,000 acting as clear upside resistance. Now we've traded near or above that level 5 times, and each time the move faded quickly. This week though, the index looks like it's taking another run at a breakout. Now the bullish case hasn't really changed. First, the Federal Reserve appears to be drifting towards a more dovish stance. Second, the economy is still expanding and could get the additional tailwinds from tax cuts and deregulation. Third, the AI trade may be broadening beyond hardware into the energy providers powering the build-out and the companies that could use AI for real productivity gains. Now, a big part of the Fed's dovish narrative depends on the labor market cooling. Now, last week's weaker than expected ADP, that's private payrolls estimate, and JOLTS numbers both supported that view. Now the focus shifts to the delayed BLS Nonfarm Payrolls report on February 11th, and expectations are for the addition of 68,000 jobs. If payrolls come in meaningfully below that, it could challenge the idea that we're in a steady expansion, especially with AI-related labor shifts and evolving global trade frameworks in the background. Now, if the report shows more than mild weakness, markets could react quickly. Of course, this whole setup also depends on inflation continuing to cool. CPI is due on Friday with expectations for 2.5% year-over-year reading. If inflation lands in that neighborhood, it may reinforce the bullish equity narrative and prove the odds of a relief-style move, though the market's reaction will still depend on positioning and expectations. So if a trader believes that the market will rally over the next 10 days, they could express that by buying the February Week 3 Friday, which expires February 20th, 70-60, 70-80 call spread for 7.5 ticks, with the underlying March futures contract at 69.98. This trade would cost 7.5 ticks or $375, which is $50 per tick. That would also be the maximum amount you could lose. The maximum gain would be the 20-tick width of the spread minus the 7.5 ticks we paid. This would be 12.5 ticks or $625. Now, if a trader believes that the next 10 days will be a difficult one for the stock market, they could buy the February Week 3 Friday 69.80, 69.60 put spread for 6.5 ticks with the same 69.98 underlying in the March futures contract. This trade would cost 6.5 ticks or $325. That's also your maximum loss. The maximum gain would be 13.5 ticks or $675.